All right, let's dive straight into this explainer. We are embarking on a massive, and I mean massive, investigation today. We've been sifting through a universe of 247 global securities to uncover which ones are actually worth your hard-earned money. But right off the bat, let's establish some ground rules here. The list technically says 247 stocks, but we are absolutely not counting duplicate over-the-counter, or OTC securities twice. You see, several of these giants trade under a few different tickers, and we're not going to fool ourselves by double-counting the exact same business. We want the unvarnished truth hiding in the data. And that brings us to the core question, staring us right in the face. If you had $100,000 sitting in your account today, which of these companies would you actually hit the buy button on? I want you to completely forget about which company has the most famous brand or, which stock went to the moon last year. What we are hunting for is the absolute best combination of future growth, cash generation, and valuation at today's price and risk. Because here's a little secret that Wall Street knows but rarely talks about. A truly great company can sometimes be a terrible investment, and a company everyone hates can occasionally become the perfect opportunity. Take Samsung Electronics, for example. It is the absolute perfect illustration of our first major trap. At first glance, you'd think you found an automatic winner. I mean, Samsung, the company, just produced a record quarter, boasting an incredible 89.5 trillion won in operating profit. They even announced a massive shareholder return plan of up to 110 trillion won by 2026. But look at Samsung, the stock. Despite those astronomical numbers, it still fell sharply. Why? Well, because the market's expectations were just way too high. It's the ultimate buy the rumor, sell the news scenario played out on a multi-billion-dollar scale. If absolute perfection is already priced in, even a record-breaking quarter isn't going to save you. Then you've got ASML and their massive 2026 sales expectation of 34 to 39 billion euros. These guys practically own the advanced chip supply chain. They hold a near monopoly on the insanely complex machines needed to manufacture the world's most advanced semiconductors. They've got fantastic gross margins and a massive 12 billion euro buyback program. But again, we have to ask the uncomfortable question. How much of that future success is already baked into the price? The market already knows ASML is extraordinary, so when you buy in, you are paying for the future earnings that today's premium price already assumes. Valuation is literally everything. Now let's bring Tencent into the mix, because this highlights something absolutely vital for us: capital allocation. They have businesses spanning across gaming, WeChat, AI, cloud, you name it. But underneath all that flashy tech is a steady, relentless drumbeat of share buybacks. And this is a great reminder of the fundamental ways you actually get paid as an investor. You see returns through company growth, dividends, share buybacks, or pure speculation. Those first three, that's fundamental economics. That last one, speculation, is just hoping there's a greater fool waiting down the line to pay more than you did. Tencent's consistent buybacks signal a real commitment to those fundamental returns. Which brings us to the relentless treadmill of the healthcare sector. Look at a giant like Roche and what we call the pharmaceutical puzzle. On the surface, Roche looks incredibly solid, pushing their core operating profit up 10% in the first half of 2026. But if you flip to the other side of the ledger, sales from older products facing expired patents actually fell by 8%. So the crucial point you have to figure out here is whether a company's pipeline of innovative new drugs can actually outrun the inevitable revenue destruction caused by their older blockbusters losing patent protection. It's a constant race. Okay, but the rules change entirely when we cross over into the financial sector. HSBC just reported an unbelievable 23% profit jump to $19.5 billion, along with an 11% revenue increase and hefty share buybacks. It looks spectacular on paper, but because banks are inherently leveraged businesses, we have to look past those top-line numbers and ask a much tougher question. How much risk are you actually accepting to receive those earnings? Bank profits often look their absolute best right before credit conditions deteriorate and the interest rate cycle turns. High returns routinely mask high leverage. But wow, there is an even bigger problem when we investigate the tech sector, specifically Alibaba. Initially, you look at them and see a totally respectable 9% revenue increase. But dig into the bottom line for a second. Their near-term net profits have literally collapsed by 75%. That is a staggering, mind-blowing drop for a company of this magnitude. What on earth is happening behind the scenes to cause a total profit wipeout while revenue is still climbing? Well, here's the answer, and it perfectly captures the intense tension playing out across the entire tech industry right now. Alibaba is funneling a massive 75% surge into AI capital expenditure, which vastly outpaces their 45% cloud revenue growth. They are spending aggressively to build out AI infrastructure, And this forces us to ask a really critical question. When does this kind of investment become long-term value creation? And when does it just become the destruction of shareholder capital? If management is right, this spending builds a dominant future. But if they're wrong, investors might be waiting years for a payoff that never actually arrives. And that forces a major pivot in our investigation today. While everyone else is obsessing over which tech giant is going to win the AI software war, they are completely missing the more profitable question. Instead of trying to pick the ultimate software winner, we need to ask, who actually gets paid when everyone else is spending billions upon billions on AI? Who is supplying the literal picks and shovels for this modern gold rush? Turns out, companies like Siemens and Schneider Electric reveal the answer. The AI boom isn't just about chips and code, right? It's a massive physical, industrial infrastructure story. Data centers require enormous amounts of power, specialized grid equipment, automation, and intense cooling systems. Because of this hidden demand, Siemens actually saw its industrial profit jump 25%, and their data center business saw triple-digit order growth. This completely changes our investment map. The real winners might not be out in Silicon Valley. They might just be the century-old industrial titans powering the digital future. But on the flip side of that AI boom is SoftBank. Their heavy exposure to AI ecosystems, including huge investments in OpenAI and ARM, makes them a fascinating capital allocation machine. But there is a massive catch. A rumored $10 to $20 billion bond sale shows us that when AI becomes a highly leveraged investment strategy, the upside opportunity carries intense financing risk. You really have to ask yourself, who owns the upside and who is left holding the bag and carrying the debt if valuations suddenly hit a brick wall? Let's shift gears for a second to geopolitics. Companies like BAE Systems and Rolls-Royce are experiencing incredible growth right now, fueled by global defense spending. BA's order book has nearly doubled in recent years, and they've raised all their profit growth forecasts. But we have to separate the exciting headlines from the actual valuations. Defense spending is undeniably growing, for sure. But as an investor, you still must neutrally determine how much of that anticipated growth is already perfectly reflected in today's stock price. A great strategic asset is only a great stock at the right price. Because, expectations can turn on a dime. Take Novo Nordisk, the absolute darling of the weight loss drug boom. They recently guided for a potential sales contraction under a new reporting framework. Meanwhile, luxury giant LVMH has seen its stock drop roughly 30% this year amid slowing sales. These two examples are the perfect reminder that yesterday's stock chart doesn't buy you tomorrow's cash flows. But they also pose a thrilling question. Is a stock like LVMH fundamentally broken? Or is a highly profitable company falling out of favor actually presenting us with a genuine, rare value opportunity? So we've gathered enough evidence to build the ultimate 8-factor test that every single company on our list must pass. We evaluate earnings, cash, valuation, growth runway, capital allocation, competitive mode, and risk. But that 8th factor is the true secret weapon: investor expectation. What does the stock price already assume? Because honestly, a company growing at 8% that is priced for disaster might actually be a vastly better investment than a company growing at 20% that is priced for absolute perfection. Now, before we reveal our final verdicts, there is a hidden structural trap we have to address. Many of these incredible global giants trade as OTC, or over-the-counter, securities in America. If you are a U.S. investor, you aren't just evaluating the business itself. You also have to navigate fluctuating currency rates, lower liquidity to totally different accounting standards, and foreign withholding taxes on your dividends. A European company could have a flawless balance sheet, but its U.S. OTC stock can still provide a really clunky investor experience. You have to mathematically factor this into your risk model. All right, the moment of truth. After filtering all 247 securities through this strict framework, we land on our final verdict matrix. A buy rating is exceedingly rare. It only happens when incredible fundamentals and an attractive valuation perfectly align. Watch means it's a great company, we're just waiting for a better price. But I really want to emphasize what sell means here. It simply means the current risk-to-reward ratio is financially unattractive from today's starting point. It doesn't mean the company's going bankrupt tomorrow. It's just about being ruthless and disciplined with your capital. So as we wrap up this explainer, I want you to remember that your goal as an investor isn't to simply point at the world's most famous or technically proficient company. Your true job is to ask yourself one single question. Which company gives you the absolute best risk-adjusted future return from today's starting point? What price would actually make you hit the buy button? Because the real secret isn't finding a great company. It's finding a great company at a price the rest of the market is simply too afraid to pay. So look at your portfolio right now. Are you buying companies or are you buying prices?